All right, this is Ubaid on behalf of Electronics, and in this video, we'll be talking about elasticity of savings. Okay, so this is elasticity. And when it comes to elasticity of savings, okay, this has to do with financial capital, so your savings account, for example. And the independent variable that we're looking at over here is your interest rate. Okay, so your savings are dependent on your interest rates. And we know this from the past few videos, okay, relevant to monetary policies. Okay, that when the central bank pumps money into the system by buying treasury bills and bonds, okay, it reduces the interest rate. As a result of which there is more money supply in the bank. The bank is able to lend more money, and the borrowers are able to borrow more money. That covers individuals, households, and businesses. Okay. And when this happens, okay, eventually, if this keeps on continuing, okay, it's possible that the country might face inflation. And when the country does face inflation, the banks, okay, may have a higher interest rates. Okay, so the central banks may raise the interest rates, as a result of which, okay, you're going to have more saving and less borrowing. Okay, because households and firms are going to say, hey, listen, yeah, why not take advantage of the interest rates offered by the banks, offered by the commercial banks? Okay, if we have 8% or 6% interest rate for the savings account, all I need to do is deposit my money in that savings account. And when the interest rates fall, I will withdraw that money because it will no longer be profitable to keep the money in the savings account, and then I'll spend that money. All right, so that is basically your savings account in reference to your interest rates. Now, elasticity of savings, this is a similar concept. Okay, when it comes to your financial capital and savings. Okay, so this has to do with is your interest rate over here, and this is either QD or QS. Okay, as the interest rates go up, your savings go up. Okay, so supply of savings from households and firms will go up. As interest rates go down, supply will go down. All right, and as interest rates go down, your demand for savings will go up. Okay, and as interest rates go up, your demand for savings will go down. All right, so this is either QS or QD in reference to savings. So again, this is demand. All right, so if we were to talk about elasticity over here, okay, assuming that this is your vertical line, which represents infinite inelasticity, and this is your horizontal line that represents infinite, okay, elasticity. As the supply curve moves towards the horizontal line, it becomes okay, more elastic, all right, which basically means okay, that the borrowers are able to decide whether they want to spend okay, or borrow money okay, with a little bit more flexibility, okay, despite the change in interest rates. Okay, so even if the interest rates were to go up, it's possible that the borrowers need money, okay, for things such as their credit card payments. Okay, maybe they need to borrow money for mortgages, okay, mortgage loan, a line of credit, personal loan, car loan, so on and so forth. As a result of which, if they're flexible, okay, then the supply will be near your horizontal line. If they're not flexible, okay, if they don't have an option but to stop borrowing because otherwise they will go bankrupt or they won't have enough money to pay the banks or other private lenders. So in that case, your supply curve will move towards inelasticity, which is your vertical line. So it will look something like this. All right. So this is basically how elasticity works when it comes to elasticity of savings. On behalf of V Electronics, this is Ubaid. Have yourself a great day.